And I'll just add now at this point that we will be recording this webinar for later viewing pleasure. We are happy to take questions throughout. You can use the raise hand function or put your comment in the chat. If it feels relevant to something that Anjali's talking about on the fly, James, Caitlin, or I can interrupt her and ask to answer the question right away. And there will be a Q&A section at the end. I'm wondering if there's, oh, the community agreements were also on that slide. I'm sorry, I don't know what happened to that slide. We have a set of community agreements at CADE for all of our programming that just kind of lays the groundwork for having a nice, open, and kind space to share with each other. So James will also pop a link to that in the chat, and you can take a look at it. I'm sorry, that should have happened first. But I think now we can move into letting Anjali introduce herself. And I will stop sharing now so that you can take over.
I'm off mute. Hi, everyone. Thanks, Rhiannon, for that great introduction. And hang on a moment while I just pull this up. I just want to make sure that I can share the view I want to be sharing. Okay, great. Can everyone see my screen?
Yep, looks good.
Okay, great. Hi, everyone. I'm really excited to be here today and to be working with CADE on their winter series of workshops, and to be talking about the especially exciting topic of cash flow management. This one's really close to my heart. And so I'm going to get started and just walk us through some of the things that I'd love for us to cover today, and would definitely encourage feedback, interaction, questions, things that come up along the way. If there are things that we can address in the flow, I will do that. And if there are questions that we'd like to sort of save towards the end, send them in anyway, just so that we don't lose sight of them, and then we can talk about them towards the end as time permits. So just a quick introduction. I run Bernoulli Finance, a company that we founded about 8 years ago with my two partners and principals. We assist what we call mission positive ventures, so companies essentially operating with an ethos of social and environmental responsibility with all of their financial planning and operations needs. We work heavily in the food and farming sector, and so this is cash flow as it relates to this specific industry sector is something that I think we're very familiar with, and see a lot of we see the rhythms of what happens in terms of, you know, the fluctuations, the flush periods and the crunch periods, and that's what kind of inspired putting together this information that I'll be sharing with you today, that will hopefully be helpful and as you think about planning and, you know, planning for and growing your businesses. So let's start with what my goals for today are, and then you know, obviously as our discussion takes it, there may be tangents that might be related to these, but in general, what I would really like to have all of us leave with today is an understanding of how cash flows affect business operations and vice versa. How to really use a creatable forecast that then allows you to make business decision scenarios, because numbers in themselves are just numbers. Using them to actually get to the point of making business decisions is, you know, why you need to and should have them. And then discuss relevant indicators that point us towards potential cash stress, or the opposite, being in a period where you know, cash is in a good place, and then being able to use it in the best possible way for your business and optimally for your own lives. So I'm going to get started with the course of this. If there are, I'm assuming everyone can hear me clearly and no tech issues so far, because that's usually the piece I'm dealing with at this point, but all good. Okay. All right. So here we go. Okay. So when I think about cash flow, and at the end of the day, I think this is something that all of you as business owners would have come across, is that cash flow and managing it, it's all about timing. And if you think about cash and consider essentially two main types of businesses, you have the first kind where you create a product in response to receiving orders. So you have your sale before your production. And you have a second kind where you're creating the product. And the creation of the product could be an actual food product that you're selling in the market. It could be the preparation of the land and the planting before you get to harvest and before actually taking your product out to market. So creating product and then selling it. So basically production before sale. Most small businesses, if you were to think about where their cash cycle lies, do they receive their deposits, their cash deposits before delivering product, or the other way around? Typically fall in that second category. You're essentially, even though you might have a mix, sometimes you might have a mix. For instance, if you have a CSA program, so you may have your cash coming in prior to having to deliver product, but even so, if you have a mix, chances you're leaning towards the second, which is that your investment in creating product is occurring prior to being met by sales. And really what that means is that you always have to be on top of your cash. Because if you aren't, it is really, it's a statistic across the United States that the main reason why small businesses fail, why any business fails, is running out of money. At the end of the day, you may have a really good product, great market demand, sales, a good supply chain, which is nothing to sneeze at these days, and essentially have all of the pieces aligned for setting your business up and running. But if cash flow isn't happening with a timing that allows you to manage your inflows and your outflows in time, if cash runs out, that's it. There's absolutely nothing happening in terms of operations. And so, simple solution, sure, don't run out of money. And cash is really, it's critical when you think about it at inception for day-to-day operations for your growth. It obviously is important for you to meet working capital needs, any needs that you might have in terms of larger expenses, and then the day-to-day needs of just running your business with operating expenses. So if you were to be asked, okay, if you were to ask me, okay, what's the best way to track and manage your cash? Is it now that, let me say that I have all of my business operations planned out or running, and I've been keeping good record of my numbers. I've been tracking what's been going on with them. And if I was to use those, basically my financial statements, would that be able to tell me what's going on with my cash flow? So for instance, your P&L, also called your income statement, tells you your business profit. Is that sufficient? The P&L is one of the three main financial statements that a company essentially uses to report and look at its financial performance. So I'm going to do a quick recap because I know that everyone's in a different stage or maybe a sort of a life cycle business phase in terms of where you are. You may be keeping track of your numbers with an accounting system. You may be keeping track of them on paper. You may be keeping track of them in an Excel sheet. You're hopefully keeping track of them, period. That's the place to begin. And if you are keeping track of them in any of those systems, essentially at the end of the day, what you're really looking for is what's coming in and what's going out, and taking a look at the associated timing. So let's assume that you do have a set of financial statements that you're working with. Typically, these are easiest to pull from an accounting system because it's just a click of a button. But even if you're keeping track on paper or spreadsheets, it's essentially the summary of everything that you're putting together is what your financial statements are going to look like. I'm going to run through a quick recap just so we are on sort of the same page in terms of what we're looking at when thinking about cash flow. So the three financial statements that a business typically uses to evaluate performance are the profit and loss statement, which is a summary of all of the operational activity that your business undertakes over a period of time. You're making sales of product, great. You're incurring costs to make that product, part of the P&L. You are paying for labor, you're paying yourself, hopefully. You're paying for potentially land lease costs, utilities, any other fuel and feed, possibly paying for marketing and advertising costs, potentially paying for travel. All of those pieces in terms of day-to-day occurrences show up on your P&L. Your P&L or income statement essentially reflects a period of time. So you could have a profit and loss statement that talks about 2021, what happened in the last year, or January of 2022, or the first quarter of last year, and so on. So it typically covers a period of time and shows you what's going on with your business operations during that period of time. You have a second financial statement called the balance sheet. Now, balance sheet is different from a P&L in that it is just, imagine if you were to take a photograph of yourself today and we took a look at it. We would see you looking a certain way, but it doesn't necessarily tell us anything about how you might have looked like 2 months ago, a year ago, 3 years ago, and so on. A balance sheet is just that way for a business. If you were to look at the balance sheet as of today, because every point that you look at is as of that point, it does not cover a period. It shows you what the company owns. So all of your assets, you have cash in the bank, you might have equipment on the field, you might have inventory, you might have land. All of those pieces are things that business owns. And then the related liabilities that you have potentially taken on in order to build up that asset base. So this would be debt. It would be anything that potentially, balances on your credit card, any loans you've undertaken, any loans you have provided to the business yourself, and so on. And then the difference of the two, what the company owns less what the company owes, is the value, at least on the books, of what your business is today, your equity as a business holder. So if I was to look at a balance sheet today, I'd be able to tell you what your company's ownership and business value looks like today. If we looked at it 3 months, let's say 3 months prior, or 6 months prior, or at a certain point at the end of 2020, perhaps, we could start seeing a story begin to unfold, just like photographs of you would tell a story over time. Your hair grew long or short, your clothing sense changed, your location changed depending on your background. It's a very similar thing in terms of looking at a balance sheet to be able to tell what a business is doing over time. The two of these put together, your profit and loss and your balance sheet, P&L statement and your balance sheet, start to create a very holistic view of what your business is doing. One saying what's happening on a day-to-day basis, and one saying what the business just owns and owes over a longer term period in time. There's a third statement that often kind of gets left behind, particularly since, especially if you're pulling it out of an accounting system, it's talking about the past. It's talking about what you did in terms of cash flow. And it kind of tends to get left behind because of the fact that everyone is focused on how the business is doing operationally. What did I do in sales? How much have I incurred in costs, and so on. And sometimes if you're looking at it, the balance sheet as well, as in, how much am I owed by people? What bills do I have to pay? All of that. The cash flow statement pulls the two of these together. It basically is a view of what the movement of cash in your business is. Because it's historical, sometimes it feels a bit useless because of the fact that it's already happened. You're, in a place where you're like, okay, I know that this moved and the cash went in this way and so on. I can actually even see the difference in my bank account over time. So it kind of tends to get left behind. But if you were to consider what's happening with the cash flow of your company, the P&L is not the place to be looking. Your business profit, as per your P&L, what you see in terms of your operating expenses, is not the same as what's happening with your cash flow. Your P&L might be missing, among other items, any cash that's missing from sales you haven't been paid for. So for instance, you make a $5,000 sale to, in wholesale to restaurants in the month, but they haven't paid you in terms of, let's say, farm products that you've sent out, and they have, restaurants in your area are going through a hard time, and it's going to take 30 days or 60 for them to pay you back. You might record that as a sale, but you don't have the money for it to show for it as yet. It's still to come in. So that sale might be on your P&L because you've actually delivered product, but you don't have the actual cash. Your P&L will not show cash that's caught up in stored inventory, assuming you're keeping track of inventory separately. Let's say you buy stores of grain, feed, or fertilizer, things that you keep aside, packaging, if you have packaged products and things that are going out. So essentially, all of that might be sitting, if you keep track of it separately, on your balance sheet and may not show up on your P&L. Your P&L will not show anything that was spent, cash that was spent on assets. So for instance, if you buy a piece of equipment, you purchase a labeling machine, you buy a truck, you make an investment in building out an outhouse and a barn. All of those pieces, if you're working with a tax accountant, they would say, hey, this is an investment that the business is making that you are going to benefit from. The business is going to benefit from over a period of time. So it's not going to show up on your P&L. It's not going to show as cash outflow on your P&L. It might also, your P&L will also not show any money coming in from loans or investments, because that's typically what the balance sheet is there for. You record an incoming loan or an investment as cash in the business coming into the business. And the opposite, it's not going to show you any cash outflows in repaying the loan principal or any distributions or draws that you might make as an owner. So at the end of the day, depending on how your books are maintained, because maintaining them and filing on a cash or accrual basis might change a lot of things here, but it still stands. Sorry, I'm trying to move the Zoom chat thing. It's in the middle of everything. But basically, depending on how you keep track of your books, how you file, whether you file on a cash or an accrual basis, which is something if you're either filing solo or working with a tax accountant, you may be aware of already. Some or all of these items might be reflected on your balance sheet, and they still affect your cash flow. And some of these are pretty bulky, especially when you're starting to make big investments, or you're expecting incoming loans, or you're waiting on a number of customers to pay up. And this is where the P&L fails you in terms of tracking cash. Now, don't get me wrong, a P&L is a very, very useful financial statement. You absolutely have to be looking at it in terms of, what the business is doing to understand your operations and make sure that you're set up in a way to run efficiently. But at the same time, getting a sense of what's going on with cash may not come from there. Right? So your cash flow statement. Yes, if you are using an accounting system, your cash flow statement is a report option. It will show you, this is what I have here as a typical example of what might be pulled out from an accounting system. It's going to show you all of the various activities that drive cash, incoming and outgoing. So the three main categories that cash flow is usually categorized in is any cash flow that's coming in and going out due to operating activities. This is literally you being out in the field or you being on the production floor and creating product for sale and paying people and paying utilities and keeping the lights on and so on. Any investing activities, this is you purchasing a fixed asset, for instance, the truck or the freezer or the labeling machine and so on, or you making a security deposit, for instance, for land or a building you might have leased. And then financing activities, which is any money that comes in and goes out as loans or lines of credit or equity draws and so on. So a cash flow statement will typically split out this. If you're using an accounting system, it'll typically split them out, the activities out in these three, and it'll show you how much cash was used or generated over a period of time. Assuming you're using an accounting system, this is a click of a button. If you're not using an accounting system, but keeping good records, it's still something that you can relatively quickly pull out, basically looking at what did I do in the month of January? What did I do last year? What did I do last quarter? And so on. It also shows how it was used or generated across these 3 activities. And like I was just saying, it covers a period of time, a day, a year, anything in between. If you're not using an accounting system, there is a little bit more manual work involved, because essentially what you're doing is collating your bank statement data or anything else you've been keeping track of to essentially, in terms of your records, to say, okay, what's going in and what's going out. So a software will make it easier, but at the same time, it's not impossible without one if you are maintaining clean business records. So this is something that I'm going to leave everyone with to take home to do if you aren't doing it already. And if you are, that's great. Basically, take a look at all the cash flows within your business. Use your bank statements. Take a month or 2 as an example. Maybe take a quarter. Take October to December. If you have a business that's up and running already, if you're planning to start something in the near future and the cash flows haven't started coming in or out as yet, even just laying out what you expect to have come in and go out is a great start. And we have a tool here that we're going to share with you for you to be able to do that. So take your bank statement, take a month, a quarter, identify every transaction as an in or an outflow. And that's easy because, you know what's coming in, what's going out by looking at your statement. Identify whether, based on what we've just been talking about, they're operating, investing, or financing activities. Again, operations, anything related to day-to-day. Investing, you're buying something for use over a long period of time. Financing, you've received money or you're paying back on money that you had received previously, or you're taking a draw as an owner. You're not on payroll, you're taking a draw separate from being on payroll. Those would be financing activities. So you mark those out in your. And then if you have your accounting system available, export your cash flow statement from it to compare what's going on. It'll get you to a point of really understanding what your cash flow statement is telling you, because admittedly, when they come out from an accounting system, they look a bit obscure. Like this is to the right is not very friendly. I will say that. So this is why running a comparison with your bank statement over a period of time to try and understand how your accounting system is classifying these things will make it easier and easier for you to quickly read your cash flow statements going forward. And then get a sense, once you have a sense of what this is saying about your business, you are going to be able to use this information to now start planning ahead, which is the most important thing, because what's happened with cash is great and useful to know. What we're going to do with that information going forward is why we're all here. So let's talk about future cash flow. Why plan for the future at all? A lot of times when I speak with small businesses, typically, and frankly, any business, and you talk to them, I was just having a conversation yesterday with somebody who said, I think that forecasts are just made out of thin air, because you don't know what's going to happen. And particularly in the last 2 years, things have been, not certain for a lot of us. And so just trying to figure out what's going on, when you're thinking about the future, when you don't know what's going to happen in the next 6 months or the next 12 months, and what might be shut down and what isn't, and what might be available and so on, it feels sometimes like a futile exercise. I'll stand here and say that as much as planning involves a lot of uncertainty and guesswork, at the end of the day, if you don't have a plan, you're not setting goals for yourself. And so basically, one of the biggest reasons to plan for the future is to set goals and expectations for yourself and your business. You've chosen to spend your time in this webinar. You've chosen to spend your day on your business. You've chosen to spend your month in your activities on a day-to-day basis at the cost of something else. You're here and not doing something else. And so setting goals and expectations for where you want to be heading feels fairly important, because if the business is If those goals and expectations are not where you eventually hope to be, whatever you set for yourself as a realistic goal, if you look at that and say, well, that's not really where I wanted to end up being, then maybe we should, should know that today and acknowledge what that might mean as a change for you, a change in strategy, a change in geography, a change in, maybe modifications in your business plan, things to think about. So even if it feels like guesswork, setting those goals are a first step towards getting to a plan. If you have a plan, you have a course, and you can then act when things go off course. So if you have a plan and you know what you're expecting in terms of your cash flows, let's say, and then you see that your actual cash flows are not matching those at all, you can course correct. Maybe the new course is great and that's what you stick with. And maybe you decide that this is really not the way you were expecting to go, and you may run out of cash at some point in time, or sales aren't necessarily leading with the product you really had in mind that you invested the most in. And you know that because you had a plan to begin with, to determine if your venture is worth all that you're giving up to do it. It's your sweat, blood, and tears. And I always say this, you're the first investor in your company. It's your time, your resources, and you want to make sure that you're giving this your best shot with a plan. And then to anticipate cash runway, which is the length of time your cash reserves are going to last you. Because once the cash reserves end, the business essentially ends. You might say, oh, I can get a loan. Oh, I have money I can draw on. Those are cash reserves. So just because you might be able to lean on something from the outside doesn't mean you shouldn't count it in your plan. You have to be able to anticipate your cash runway. And then to figure out what you need to be doing before you run out of money, because it might mean raising money, which is a job in itself and requires a long runway to think about stuff, to think about getting there, or changing strategy, or figuring out, and that change of strategy might be a lot of things. Business lines, geography, like I mentioned, business, just plan overall, your life plan. So what I believe has already been, we've shared, right, Rhiannon? You may have received this already.
It's in the, James put it in the chat. So if anybody's looking to see it.
Great. So what we're sharing with you today is a fairly simple cash flow tool that's set up in as a Google Sheet template. You would have received a link to it. I would suggest just making a copy of it and then using it for your purposes. I'm going to just flip my screen to the actual Google Sheet as well to walk you through some part of it, but this is just a snapshot of what it looks like. When I think about cash flow, I literally model it thinking about the operations of the business. So you'll see when you look at the tool that it looks very much like what you would have expected your P&L to look like. You have the sales, you have the cost of sales, you have the pieces below it, and then you have components that you don't see on the P&L, like your capital expenses, because that is actual cash outflow as well. So hang on a moment. I'm just gonna, let's see, stop share. There we go. Screen. Okay. Oh, great. I see a number of people on it. Great. So what this is a very simple start to tracking cash. We've set it up to track cash over, say, an 18-month period. I typically say that 12 to 18 months, honestly, 18 months is the minimum you want to be looking at cash for, because 12 months is great if you're setting up a budget, but it takes 3 to 6 months to figure out where new money might need to come from. And you don't suddenly want to be doing this in the middle of the year, right when things are at their busiest. So try and figure out, like an 18-month roadmap in terms of what's happening with your cash, even if it feels like month 13 to 18 are just, you know, you doing some guesswork in terms of what the next year is going to look like. It's a start. And so the way we've set this up is you have this set up in essentially the structure of a P&L. You start with sales and you have your various channels. You have cost of sales, which is all, you know, they're all the variable costs that are related to your sales, essentially almost growing one-to-one with your sales proportionally with them. And then you have operating expenses. Something to keep in mind, and I've noted it up here as well, is that everything that's in black here is formula based. Everything that is in blue is changeable. That being said, if you have completely different sales channels, feel free to just go ahead and change all the names in here to what you need them to be. The only thing to be careful about if you're unused to navigating spreadsheets or Google Sheets in general is that if you're adding rows, add them in the center. I've added that as a last, the 3B note in there, add them in the center so that you make sure that the sum, subtotal, all of those formulas just stay intact. They're fairly simple formulas. So even, you know, they're easily fixable if something gets messed up. Now, essentially, when you're thinking about setting up your cash flow tool, here's the thing. Number one, the reason I've called this tab scenario 1 is with the idea that you could replicate this as many times as needed to run different scenarios for your business. Number two, when you're starting to lay out what you think is going to happen over the next few months, you know, actually, sorry, that's number 3. Number 2, the reason I've called this month 1, month 2, month 3 is that you don't have to start in January. It's not too late. Any time is a good time to start thinking about tracking cash flow. So if month 1 is February 2022, great, let's just get started. And number 3, when you're thinking of the numbers that go in here, and we're going to talk about how to work through your projections in this next few minutes, but when you're thinking about putting the numbers in here, keep in mind that we are setting this up, as much as this looks like a P&L, we're setting this up to be a cash flow tool. So if you're anticipating $3,000 in sales of produce to local restaurants who are not going to be able to pay, or who generally, because of your net payment days, pay 30 days later, don't put that 3,000 in the month that you made the sale. Put it in the month that you expect the money to come in. And if you kind of expect a 50-50 split, hey, I'm gonna, half of them pay almost immediately, the second half are gonna pay a month later, then set it up that way, because this is all about cash flow. The same thing goes with something to think about if you have CSA subscriptions. If you're getting the money up front, let's say people are buying into subscriptions now for deliveries over the summer, count that cash now. Your accountant, etc., depending on how you're keeping your books, might say, hey, we don't recognize that as a sale until you deliver the products. But from a cash flow perspective, we are counting that cash in now because you have it in the bank and you're going to be using it for a number of things. So we don't want to anticipate you're getting that cash later. It's not coming later. You have it now. And if there's a risk that you ever have to do refunds for cash that you've received in advance for something, then that's something that you account for further down the line. It could be a scenario, a refund scenario. Hey, we've got to turn back some of the money because of whatever reason. What if that was to happen in terms of a risk? The same thing counts is relevant for your cost of sales as well.
Anjali, can I interrupt you real quick? We
Sure.
had somebody ask if you can demonstrate how to add a row without messing up the...
Sure.
Thank you.
So here you see this is the subtotal formula where I am in black. And then you have all of these 5 rows below, all of which are hard-coded numbers for you to add in assumptions. If you don't want to use something, just say, all right, I don't have an other stream. In terms of adding in row, the reason I've kind of just want to make sure, yes, I do have an other at the end of every category, as you see here. The easiest thing to do would be to go here. I'm right-clicking. If you use Macs, I don't know what you do. I'm sorry. but right-clicking and then doing an insert row above, not below, above the other. So just always, my other is kind of a safeguard so that we don't mess up the formulas. Add your row above the other. If you do that, you'll see that this formula extended down to capture all the way to the other. If I was to do the other way around, which is to take that last row and add a row below, if I look at this formula now, I've missed this capture. And so it's not going to be caught in my farm income production in this category. So in terms of adding your row, just always work with, take the other and just add one above. I hope that's clear.
Does that get your question, AC?
Yes, thank you.
Great.
The same thing with cost of sales when thinking about cash outflows. If you are spending on seed, fertilizer, packaging, raw materials, whatever it is in chunks, no matter how you keep your books, and if you're keeping them, you know, we could get into a whole other discussion of keeping books so that costs are recognized in tandem with sales, which is really how they should be done. In terms of cash flow, this is, you know, you recorded when the cash is expected to go out. So if you're going to pay for plants, pay for seeds, etc., at the end of the year, or at the beginning of the year, and then go through the entire planning cycle, or if you're investing right now, or in, you know, say you're making jam and fresh fruit comes in the summer, which is when you've got to grab as much of it as you can and go through your production cycle. Reflect that in thinking about your cash flow. That's when the biggest chunks of money go out, and that's what we should have here in terms of timing. That's what we're aiming for. If you're using credit cards to pay for things and you then have a month to pay off your card, if you pay it off in full, then I would basically put your expenses just a month later than when you actually made the purchase, because you're going to be paying off the card in full. If you're carrying a balance over time, in that case, you will have to make some adjustments below to make sure that you're actually capturing the fact that you are going to keep on paying, like carrying a balance and paying off over time. So this is something that, you know, I can work with if there are specific questions that come up, but something just to keep in mind, credit cards can trip you up, because if you're carrying a balance, you have the false assurance that, you know, you've spent the money if you enter it in here, but that's not really the case because you're going to have payments coming up in the future. So farm operate, I've included a number of categories here just in terms of, you know, general farming related categories. But again, if anybody is doing finished products, CPG, any kind of, you know, and you might be doing both, in which case I would suggest, and especially if you're keeping track of things separately, like what's happening on the farm versus what's happening in a production kitchen, potentially even separating these out, not just to be scenarios, but to be cash plans for both businesses, just to see that, number one, they're both supporting themselves, and two, what you could do. So here's what you would do with that. You take scenario one, duplicate it. Come on. Okay. And then call that scenario, or in this case, let's say you did production and farming. And then what you can do is pull together, we'll get to this in a moment, the cash flow at the bottom, pull these together into a sum. And this is something that we're actually talking about next week as well, in thinking about enterprise budgeting. So coming back to looking at cash flow, you'd be entering all of these components based on when you expect the cash to go down. Now, for instance, let's say that you prepay your insurance, liability insurance for the farm at the beginning of the year. Don't split that out, even though you might be splitting in your books, because the actual money is going out in that lump sum in whichever month you pay it. So these are things to be careful about when you're thinking about the cash flow. It's actually easier than keeping track of things on an accrual basis in the P&L, because you're literally just thinking, okay, when's the cash coming in and when's it going out? So most of this, all of this until this point, is the way you would have seen a P&L run. You have sales, you have your variable costs, and then you have all of the operating costs set up to go with it, You can create new categories, add in new lines, just change these if they're not applicable to you. Below that, okay, so I'm going to explain this EBITDA line in case anybody's not clear on what that is. EBITDA is a very just long acronym for earnings before interest, tax, depreciation, and amortization. I could also just call it operating income, which is basically, you know, what your farm is or your business is making given its sales and its other expenses. This is just in here as an indicator to just tell you that what I've essentially done is taken your revenue. If you look at the formula, I've taken your revenue, subtracted variable costs, and then subtracted total operating costs just to tell you where you were on a cash flow basis after all of that happened. Now, you'll be at a point where this comes to a piece where you don't see on the P&L. And these are the bigger expenses that you might be incurring in order to set up infrastructure, equipment, you know, buildings, etc., on your property, or equipment in your commercial kitchen, anything that you might be needing for production of making the product and so on. These are things that happen one-off, but they also tend to be significant. And they are really important to think about when you're considering cash outflow. So you might say, okay, I'm going to get a pickup truck and I'm going to get a freezer a few months down the line, depending on how my cash flow looks. So I plug that in here and kind of just play around with it to say, okay, you know, this would be an ideal time for me to get a freezer, let's say. So you're at this point. Let's ignore financing to begin with, okay? And this is something that unless you ignore it and set up everything else. The only attention that you give financing at this point is if you're already obligated to do something. So if you have no way around, for instance, you have debt service on an existing loan, those are payments that are going to be happening every month. Put that in there. If you absolutely, like if you yourself are drawing money as opposed to being on payroll, put your draws in here because you want to, you know, you're basically saying, okay, what do I need to be making at minimum and potentially more than that for being an owner operator of this business or being a part operator of this business. So let's say you put that in. You ignore equity investment, like cash inflows for now, and any new loans that you might need to take. Those are the two I would say don't focus on at the moment. But for outflow and for both in terms of draw, if you have something that you're already obligated to do, or you're paying yourself and trying to fit that in the equation, put those in there. So until this point, before we come down to this box, you have essentially worked towards setting up a picture of what you would expect things to be in the next 12 to 18 months. And again, we're just going to go back into figuring out how to expect it. Once you set it up and you're at this point in the structure, that's when we come down to this box, which basically tells you what's happening with your cash flow. Your beginning cash balance is a number that you plug in. That's what's in blue here. You would plug in whatever you're starting out month one with. So let's assume month one is February 2022. You would take a look at your bank account balance at the beginning of the month and say, okay, here's where I'm at in terms of my beginning cash. The rest of this is calculated. It's essentially taking the sum of your operating cash flows, revenue less costs, any investing cash flows, so whatever you were looking to invest here, for instance, that pickup truck, that's the 10,000 down here, and any financing cash flows, which as we see for this month are 0. And what it does is it takes your beginning cash balance and adds everything, both the inflows and outflows to it, the adds and subtracts, to give you what we expect your ending cash balance to be, given all of this activity. Now, I'm going to delete this for a second. That ending cash balance is your beginning cash balance for next month. Because, you know, you end on February 28th, start on March 1st, this is where you're at. The differences now come again from operations in March, any investments in March, any financing. This is that cash flow that you're paying out that's showing up here and tells you, okay, so now I expect to end the month at 15,500, which in turn informs the starting balance for the next month. So what you've done here is basically set up what you expect your cash flow to be. This is looking like a fairly healthy cash flow and it's growing over time. So I'm going to mess with it a little bit and basically say, okay, here is where I'm expecting a rather massive investment in my packaging machine. Okay, I put that 25,000 in there as cash outflow. That's what you see here as the outflow, which basically got me under. That's what this minimum cash point reflects in this entire cash flow. It's kind of a heads up to say, okay, this is where you're at. If it's positive, and if it's positive enough, that's a good place. If it's negative, we better start making plans. So you have a few strategies, right, at this point. And those strategies could include maybe not getting this machine at this point, maybe thinking about leasing a machine if you have the option to do that, potentially getting a loan if you absolutely need the machine and the best thing to do is to buy it and you don't have leasing options, getting a loan to do that. And so if I was to say get a loan, I say, okay, I'm going to get a $25,000 loan. You see that I'm putting it under loans to pay off this machine. But now I also have to put in the payments that I have to be making towards this loan over this period of time. And let's say that you took out a loan with fixed payments. Generally you get your loan term and your interest rate, and you have a fixed series of payments that includes both principal and interest. I would encourage you for reasons of simplicity, because we're not keeping accounts here, just include your entire loan payment in here. So let's say that 25,000 increased your monthly loan payments. Now you were already paying 500 on a pre-existing loan, and you have to pay 500 more every month to pay off your loan. So you make that 1,000 and extend that all the way. Okay. That's left us in a pretty decent spot in terms of cash flow. Don't get me wrong, this payment is not paying off your loan in full. It's just that it stops here because we stopped at 18 months. But we put that in there and we say, all right, if I absolutely have to get this machine right now, and if I'm able to access a loan and the payments on the loan are looking like this, I'm relatively still in a pretty good place. I can support the loan payments. I have that machine, and I can potentially see an increase in sales or a decrease in costs because of the efficiency from the machine. Presumably that's why we're doing it. So this is a scenario that you can play out in your cash flow to see what it looks like. Now, let's say that you've set up this scenario and it's ready to get going. You can't just leave it there because things they never go as planned. So let's say that you set it up for this first month and you expected to end at 8,100. But then when you look at your actual cash balance at the end of the month, it's 5,000. So it didn't really go according to plan. Two things. One, by entering the actual end cash at the end of the month, you're resetting your beginning cash balance to be 5,000, not the 8,100. So that's setting you on a realistic track for what's going on. Two, if the difference is high, and I would say this difference is high because 3,000 off of an 8,100 expected balance, like 3,100 difference, is fairly significant. It's a good time to look at what happened to figure out if this was just a one-off thing or something that should change your projections in the longer run. Sales didn't go according to plan, or operating expenses just ended up being higher than you anticipated. So then should you be extending that all the way, or was it really just a one-time thing? Let's say the following month you expected to be at 12,400 now with that starting balance, and you really ended up being at 15,000. That's good. You're higher than where you expected to be. It also set up your beginning cash balance for the next month at that. But it's also a good time to look at why you're higher than planned. Did something go unexpectedly well, or is it just a lag that was carried over from the past month where you were short on cash? So these are the questions you can now start asking yourself as you track your cash flow in tandem with your expectations for it. And to be clear, like let's say that you had a really bad month in March. So you come in here and you say, wow, I didn't end at 20,900. I had these crazy repairs that absolutely needed to happen, couldn't get financing for it, had to shell out the money, otherwise I would have seen a loss in all of the product that I have. And so I'm ending the month at 2,000. It's a good time to take a look at whether you really need that packaging machine. And maybe you shift things out or you figure out another form of money infusion. But your cash flow forecast is not going to fix your operating issue, but at least it's going to help indicate towards what you might need to do to get there. I'm going to switch back to the presentation, but also just want to stop to see if anyone has questions on the tool.
I have a question. What documents are helpful to have on hand in order to get to these numbers? If you think of like, tax forms or receipts or what have you. Like if you're kind of starting from nothing or
Yeah.
not the most organized.
Yeah. If you've been running your operations for a while, like business history, but you don't have things organized. Let's say that you're in a place where and again, that it's a really good question because the answer to it varies on what's available. If you have your tax records because you've been able to sort things out, like let's say you keep everything in a box, and then end of the year, and we see this happen a lot, right? You end up with a box of the receipts at your tax accountants and then sorting all of it out, and you have your tax records to begin with. It's a good place to start because then you have a sense of what was made, what you did in the last year, and what you spent, what your expenses were. And given the fact that you were on the ground, you also have a sense of, March is a better month for sales versus November. And then you can start to kind of tease that out and say, okay, I think I'm going to do better here and worse here, or this is when I absolutely need to be stocking up on items. And so I should plan for, this outflow. So if you have nothing to go with except for historical tax return, I would say take that. I know it reflects just an annual number, but take that as a starting point, split that out, even if you have to equally across months, and then start tweaking. And this is exactly what we're going to go into now. If you have something, like let's say you have a separate bank account for your business, which you should, just saying. But let's say you have a separate bank account for your business, bank statements are a really good place to start. Even if you don't have records, otherwise you're not keeping track on a spreadsheet, you don't have an accounting system. Just using your bank statements the way we had talked about, marking out the ins and outs and figuring out what drove them. I know it sounds a bit painful, but once you set this up and get into the habit of doing it, and then at the end of the day, you're just entering your ending cash balance and figuring it out. It's just that initial setup time that takes the most time. And then you get into, it's actually kind of fun. I can say this as a numbers geek, but it's actually kind of fun to see what's happening with your cash once you actually have a system for tracking it. Does that answer your question?
It does. I think we're nerds amongst nerds here.
Okay. Good company. Okay, so start by filling out numbers based on your ongoing operations. That's what we were just talking about. And then fill in the cash in, cash out associated with your investing activities. Don't rush in to fill your financing needs. Even if you know them, even if you know you're going to get access to a loan and etc., leave them blank to begin with. Like I said, unless you're truly obligated to do something like debt service, you're paying back on something that was existing, leave it blank so you can actually understand what your cash position is without that financing and get a sense of how dependent you are on it, how important, how critical it is going to be. And then rinse and repeat. Like you're essentially working, nothing is set in stone when you're thinking about a forecast. That's why you can duplicate this as many times as needed to say, Farmers market fail, what happens? Restaurants shut down because of the next variant of, hopefully not, but they shut down. What happens then? Starting an e-commerce site and starting to put my product out there. What happens then? Separating out 2 units of the business and taking a look at their cash flows. What happens then? And so this could be an iterative process that you could work through, and it doesn't have to take too much time. Just even getting the basic numbers down based on what you have, a single document potentially, and your hunch for the year. And then this is what we were just talking about, is you're looking at beginning cash plus cash in from all activities, less cash out from all activities is what gives you your ending cash. Calibrating, recalibrating every month, super important, just so that you're not just leaning on a forecast that's not real. So don't just make it and leave it, stick with it. So let's talk a little bit about how to get there.
Can we pause for just a second for a couple of questions around administrative sort of processes? So somebody had asked, how long do you think it takes to set this up and maintain? I believe it's referring to the cash flow spreadsheet itself. Just from an administrative standpoint, I know no one wants to dedicate time to sitting down with their calculator or Excel formulas.
So here's the thing. If you're an uber organized person, regardless of whatever system you're using, but you've been keeping track of your numbers, I would say that this would take you a couple of hours tops, because you have a sense of where your number, what's coming in, what's going out. And when I say a couple of hours tops, I'm basically saying you're starting to just lay out your thought process, and you might come back to it 2 days later and spend 15 minutes on it and say, no, really, that was silly. July to November cannot possibly look like that. I need to change it. But once you start doing it, you're thinking about it. If things are all over the place and you don't have your records, I will hang on this, like if you have a tax return, you have something to start with, because you've been able to parse out revenue versus expenses, and it's a place to start. You can still set something up in an hour or two and then keep coming back to tweak it over time. If you're just starting out with your business and you're thinking about planning in the longer run, I would say that this is a pretty critical part of that planning exercise, and it's really important for you to take the time to do it. So the other thing to think about too is that regardless of whatever system you might be using, let's say you have an accounting system and things are running in there, that's going to continue. You're not going to stop doing that. This piece, the cash flow piece, doesn't have to be separate from everything else you're doing from an organization perspective. It could be the place where you are doing all of the organization and planning. Don't get rid of your accounting system if you're using one. That needs to be connected, pull in your bank statements, your records, and all of that, keep that running, because that's history and you're keeping it. But anything that you're doing in terms of planning for the future, let's say that you're writing on a piece of paper, hey, it's going to be this many acres of land, that much seed that I have to get, that's how much it's going to cost me. I need to think about, X dollars per pound of fertilizer that I'm getting, etc. Put it in here. You can just add a sheet to the cash flow file, write down all your assumptions, and just say, okay, that means a $500 outlay in March. Drop the 500 in. So you can keep coming back in bits and pieces to do this, but make this your planning file.
And then, thank you. That's really helpful. And there's a couple other questions just still requiring some clarity of how does this cash flow tool compare to QuickBooks cash flow? And then kind of an extension of that, the difference between cash flow versus profit and loss statements, and where and why you might use one or the other, and why one might make more sense for different scenarios. If you can break that down with a little bit more clarity.
Okay, so if you're using a cash flow tool or a forecast, because QuickBooks is trying to definitely get into helping businesses play out, what the future looks like, and it's working for you, stick with it. Because whatever tool is working for you when thinking about a cash flow forecast is what you should be sticking with. What we are providing to you here is, let's say you're not using anything to date, an accounting system or anything else. Let's say that you're using an accounting system, but you're not using any cash flow setup that they have. Let's say that you tried to use it, but you found it too limiting because they're too focused on history, and you know that the future is going to be different. And you'd rather use something that feels like a better interface. That's why you'd use it, but you wouldn't need to use both. So it's not QuickBooks Cash Flow and this, it's QuickBooks Cash Flow or this. The thought process is the same though, and just thinking about, which is what we're going to get into next. The P&L versus the cash flow, the main difference there is, if you're talking about a P&L that reflects history, it's reflecting history. It's not a plan for the future. So what we're looking at here is setting up a plan and a forecast for the future to figure out how your cash is going to play out. You might be already doing things like creating a budget. And if you're doing that, you've got 80% of the work done already. Because if you've laid out a budget for this year to say, here, this is what I'm planning to do, I would say transplant that into something like the cash flow, just taking into account the things that I mentioned, people not paying on time. You're not, because a budget might assume, well, I'm going to go and have, $5,000 in sales and wholesale every month. And that's great. But in reality, you know that, you get 1,000 of that in that month and 4,000 the following month, or lagged over time. And so the thing that's different here between what you're doing with a P&L that's forward looking, which is, your budget, versus what we're doing with cash flow, is being realistic about when the cash flow is coming in and going out. And you might have already done that in your budget, which is great. Then you have 90% of the work done. I would say just drop in this piece, that capital expense piece at the bottom, and then use this to figure out what's going on with your incoming and outgoing cash flow. Does that help answer the question?
I think so, yeah. I think we can continue. I'm seeing more questions in the chat, but we will also have some Q&A time at the end, and we'll hold on to those.
Okay. So just in terms of thinking about how to plan, and something that I want to emphasize all the way through, with a P&L, if you're talking about the technical difference between a profit and loss statement and a cash flow statement, it is a topic that we can get into, but it's not what we're covering today. There is a big difference between them. However, many businesses that operate on a cash basis, for them, looking at a P&L or an income statement is almost as equivalent to looking at a cash flow statement. So the main focus here is making sure that you're setting up something that helps you plan out the future, not just depending on history. Because history helps lay out the basis, as we will see, but it's not really indicative of what the plan might be, the plan that you might have for the next 12 to 18 months. So how do you want to set up your cash flow forecast? How do you want to take what's existing and then set it up to look out in the future? Typically, you start with looking, assuming you have this history, at your past cash flow. I would say maybe take 12 to 36 months of data. This could be just the cash flow statement from your accounting records. So let's say you have QuickBooks running, you have that data that you can pull out in terms of your reports. It could be your bank statements. And if you don't have either of those, let's say you don't have the bank separated out, it could be your tax returns for the last year or two, just to get an annual number at least. And if you don't have any of that because you're just starting out, then you start out with what you had expected as part of your business plan. Because if you're getting started on something, you did lay out what you think it's going to bring in and what your outlay is going to be. So that's what you start with. The curves that I've shown here are purely to sort of lay out the story visually. You don't need to be doing it in curves. You don't need to be doing it in graphs, but if that's what works well for you, that's also something that's fairly easy to do within a spreadsheet setup. So let's say that you've kind of mapped out what's been happening with your cash flow over this period of time. And you see that there are times when there are peaks and it goes up. There are other times when it drops. There are times when you've realized that, it fell through and you were in trouble or you had to bring in financing to do something. So you've laid that out. As you look at that layout, and this could be just a line of numbers, drop whatever was exceptional and keep whatever you think is actually indicative of how the history of how your business runs. So there might have been March 2020, April 2020, were really blip months for all of us. And we, it is fairly exceptional. Of course, that exceptional kind of extended into a whole year and a half. But at the end of the day, we all figured out that we're changing strategy potentially in some way. So drop whatever feels like it's not part of the plan in the way the business runs, that it's truly something that skews things in a way that you don't expect to happen in the future. So let's say I have these like major drops as I'm looking at my cash flow and I say, okay, these were big investments and I'm not going to make them again. Or this was when the entire country froze over. And, presumably with things under control, that's not going to happen again in this scenario. And you take those out and you keep what feels like a relatively simple, like a relatively trustworthy is a bad word to use here, but basically something that you feel is indicative of what you expect to happen with your cash flow in business over time. So this is where you've laid out, okay, here's my history, here's what I expect to happen in the future. That's if I'm sticking with the same business model. Now, once you've laid that out, you've extended that into that 12 to 18 month thought process. This is where you're literally just laying out your assumptions for what you're thinking is happening over the 12 to 18 months. You start to adjust for exceptional things that need to happen over the year. That packaging machine that we were talking about, say you're investing in a tractor, say you're investing in other farm equipment, say you're making a big investment in setting up an e-commerce website. So these are things that may not have happened in the past, but are going to skew your cash flow this year because you have big investments and items to make. So adjust for that. All right, so let's say that you've adjusted for that. I've basically said, okay, you know what? This is going to be a drop right here because I have to make this big investment in farm equipment. This is going to be a further drop than I expected because I'm investing in building out my e-commerce site. But then on the flip side, I expect my cash flow to go up higher because I'm starting a new business channel. So I'm starting to lay out what is exceptional in my thinking process. And that is essentially, once you've laid out, okay, here's what typically happens, here's what I expect to be different this year, you're starting to lay out your cash curve. And your cash curve here, the line that I have here, is essentially indicative of exactly that last line that we had in the tool not too long ago. This piece, that ending cash balance. This is your cash curve. You have a starting point, and then you're starting to see, okay, how is that going to play over time in terms of numbers? Okay, so you've started from your current cash balance, you've projected out what you think your cash is going to be in hand. Some things to help think about that will help with planning, the way when we look at them. There are three tricks that I think about when I think about planning. Consolidate everything that's related. So if you have items that have very similar transaction timings, think about them going hand in hand with each other. So then it doesn't feel like you're addressing a really big piece of, I don't know what's going to happen in the future. You're starting to parse out things to figure out, okay, these things generally happen together. These are the pieces I generally invest in together, and so on. So consolidate. And that will, to the question about how much time is this going to take? If you have an hour, just think about, use that hour to just lay out Here's what I'm going to be paying in rent and utilities every month for the next 12 months. Lay that out in a line in the plan. Here's what I know that I'm going to be paying in, potentially fuel on average, month by month. Just lay that out. And generally starting with your operating costs is the easiest way to go, because those are things that are, more or less known outside of payroll, which tends to be more up and down. But the rest of it, we have a good pattern with the business to say, okay, this is what we're expecting. So start with that, the consolidation. The other thing that really helps with planning is starting to recognize patterns in terms of what happens. You either have transactions that are one time, a big investment, a big bonus that comes in from just signing on a new client, or somebody who has like massive wholesale order all at once. So those are the one-time things. And when you say like, this typically happens around this time of the year, or this is what I need to be making an investment in. So the one time. Then there's periodic, and periodic are the ones like operating expenses that we're just talking about. Those are relatively easy to lay out. So start out with laying out things that you know are going to happen as a result of your being part of a contract, you're having a lease, you're having people on payroll, and so on. So you're starting to lay out those pieces. And the third is factor-based. So going to this, the one time is something like an investment. A periodic is basically laying out all of the pieces that go over time, keeping in mind now, just starting with an average gets you in a pretty good place. It takes 5 minutes to just kind of put in, okay, here's what I'm expecting to do in terms of rent. This might be what I do in terms of social media. Come back to it 3 days later, and then just think about seasonality. Do you think that utility costs will be higher in the winter? Make those a bit higher. Flip side, will they be a little bit lower in the summer? Make those a little lower. So start kind of putting, sort of finessing your assumptions alongside. And then think about growth. So this is another one when it comes to sales. You might start out with, on average, I do $5,000 or $15,000 in sales every month across these channels. And then you come back and say, okay, actually in the summer I do way higher. And then holiday season also tends to be really good depending on what the product is. And then, January and February are just low, relatively dead months, or maybe not, because that's when the CSA subscriptions might be coming in. And so those are the things you lay out for sales, for instance, and start, playing around with seasonality, and then assuming a growth factor. So, hey, I did X in sales last year. In an ideal world, I want to be increasing my sales by 10 or 15%, et cetera, this year to be able to set myself up for, in order to do that, I'm going to need additional investment in XYZ. So those are, and I'm not saying that this is easy, because obviously we have an hour and a half to cover this topic. And for you, it needs thinking about your operations. But my point here is that if you start with what you know and are most comfortable with, operating expenses, then think about sales and reflect on the past to figure out what you want to do for the future. The third piece you come to then are variable costs, which tend to be the truly tricky thing. But think of those as being factor-based. So essentially, they're a percentage of something. Anything that's a transaction that's factor-based is a percentage of something else. So for instance, generally, you find that if you're selling 15 bottles of jam in a particular day, you have the costs that are associated with those 15 bottles of jam, the bottle, the lid, the paper, and so on. And you might be buying all of that volume all at once in January for production in June. Think about your sales. Take a percentage of those sales based on what you know your raw material costs are, and then lump them in the months that you're expecting the cash outflow to go. Another factor-based expense is payroll tax. If you have payroll, there's tax. And so you could have just an X% of payroll is going to be taxed, and that's going to be a factor-based thing. So thinking about consolidation where you can, just to make it easier to start, and then recognizing patterns helps to just lay out the beginnings of a forecast. let's say you put all these things together, that's what essentially gets you to your current scenario in terms of what's happening with cash flow. Now, let's assume that you've laid out that cash flow. There are things you want to be watching out for in your forecast. Once you've laid out your cash flow, and this is, let's say, that line of numbers, that month-end cash, there are a few things that become obvious. One is your minimum cash in hand. That's what we've set up the tool to show you. So within your forecast, what's your minimum cash in hand going to be in any given month? And that's important to know, because if it's not a comfortable number, then you need to be changing something to have it be more comfortable. You could also, if you're burning cash month over month, not making cash like we were looking at in the cash flow, your cash flow forecast is going to tell you when you're going to be running out of money. So it could be saying 6 months from now, you'd be running out of money unless you change something about your plan. And so that's a really important metric to look at. So once you set it up and you're looking at this, that ending cash balance line, let's say it's positive. If it's positive, is it positive enough to be comfortable? If something really goes wrong, is there going to be enough of a cash cushion to sustain you? Do you have, personal needs, business needs, anything that might arise in the next 12 to 18 months? That's a question you have to answer. I'm not saying you can fix it right away, but you can be aware of where your limits are with respect to what's happening with cash. If it's negative, how negative is it? Are you going to be able to bridge that need plus build the additional cushion you need by changing anything with respect to business operations? Can you work with your customers to step up on collections? Can you work out better terms with your vendors to pay them a bit later? Can you figure out a different timeline for purchasing equipment or hiring that person when the business isn't, or renting that space when the business is on a cash upswing? So essentially, using your cash forecast to move around the numbers a bit to say, I don't necessarily have to do this time, or this is a really great time to make that investment to then, further grow the business as I plan to, is something that your cash forecast can help with. And essentially, how are these changes, everything that you're thinking about, we want it to be reflected in that cash forecast. When it comes down to it, if you're asking how much time I'm spending on it, I would say anticipate 2 to 4 hours, half a day. Give it half a day just to think about your business and start to lay out the numbers. Give it another half an hour every 3 days for the next 2 weeks to just come back and start tweaking. Half an hour every 3 days for the next 2 weeks. So that's 2 hours more, 3 hours more. And then give it a couple of hours at the end of every month. An hour, even an hour, just to put in the balance, to see why it's so different, and then to see if you need to shift the forecast. In the grand scheme of things, if it sets you up for better planning, it's a good investment of time. If you're looking at raising money, the cash flow is that's another important reason to have a cash forecast. Any lender is going to ask you or want to see projections in terms of what's happening with cash, because they want to make sure that you have enough money to pay off your debts. And so they actually look at something that they call a cash coverage ratio. How much cash do you have versus how much you have to be paying off in monthly payments towards loans? And it's pretty important for it to be above a certain ratio for them to even approve a loan. And so you can, if you set up a cash forecast and you're able to go to a lender and say, hey, I know you prefer a 2.0 cash coverage ratio, like my cash to debt payments always needs to be a 2x factor. But there's a time of the year when I drop down to 1.2 or a smaller number, a smaller ratio, because of the fact that this is just generally how the farming cycle works or the production cycle works. Let me talk to you about it and show you how I come back to a higher cash coverage ratio. We've seen that turn around loan decisions, just having a good sense of what's going on with your cash. So final takeaways, it's really best to project and monitor on a weekly or a bi-weekly basis. The tool that you have is monthly. You can, if you really get into it and you're able to spare some time to keep track weekly or bi-weekly, especially for businesses with sensitive cash cycles, is even more helpful. Always keep comparing your projections with your actual. So entering that ending cash balance and then figuring out why there's a difference so that you can recalibrate. As those changes come to light, bring them into your projections so that the future is not based on something that you planned 3 months ago and actually reflects what you're doing now. And, you don't have to keep changing. If they're wildly off, then do revise. If they're relatively okay and you're kind of like, this is just, you can't project everything to a T, leave it as is. That's fine. Listen to your intuition, obviously. That's what we're all in the business of doing things. But at the end of the day, having your numbers as a backup is a pretty good deal. So, stop here. Oh.
Well, thank you so much. That was wonderful. And I know we're right at 6 o'clock. So if you need to peel off, you can peel off. We do have some folks with questions. Anjali, can you stay on for like 5 minutes or so to
Absolutely
do some run over? And I would also maybe offer, if we could, we're going to be with Anjali again next week for our enterprise budgeting workshop. So maybe at the beginning of that, before we start with that set of slides, we could take some overflow questions at that point. But Carrie is wondering with this, the cash flow chart that you were talking about, that's not a function of the spreadsheet, right? You're saying that is the that last chunk of lines where you're measuring your final cash flow. You would be making that chart yourself, right?
The curves, you mean?
Yes.
Once you set up your numbers in a spreadsheet, Excel has some pretty neat tools to set up the curves. So you could actually be able, basically both in Google Sheets and in Excel, essentially use their tables and graphs features to just, if visuals are more your thing, then essentially have those visuals be based on your numbers. And every time you make changes to your forecast and your numbers, they would be automatically reflected in those linked visuals.
Does that make sense, Carrie? Yes. Yeah. I'll also say, I should have said this before we offered that people can peel off. We have an evaluation for today's workshop. So if anybody is still here and is willing to fill out that evaluation, James is going to pop it in the chat. Anybody who put a question in the chat who is still here, I'd love to offer you the chance to unmute and ask your question.
This is Mark. I don't know if I can ask a question here. I can turn on my video here. So we are, hi there. Great presentation, first of all. But anyways, we're still in the startup phase and looking for projections and putting our business plan in for loans and that kind of stuff. How in depth do you really think that it really needs to be? Like 3 years out, looking at projections is what I think the bank is looking at. I mean, just using what we have and going through like all of our expenses of what we need in general, and can come up with that number too, I guess, as far as a loan, and how do you go about looking at that? I guess where should I be looking as far as my numbers? If we have no cash flow coming in at all, and we just have a little bit of startup cash as well.
I think so. If you're working with a lender, whether it's a traditional lender or something like a farm credit union and so on, typically 2 to 3 years is sufficient. They're not asking for more than that. I would say 3, and then you can always cut back if somebody, but generally having that 3-year piece laid out makes a lot of sense. In terms of how you go about it, essentially whatever you're thinking that your business is doing, I would, if you don't have a structure in terms of a plan already, use something like the cash flow tool that we've shared today. And also in terms of just planning and budgeting, when we're speaking about it next week, using a budget, a forecast tool, It's more of a thinking process so that you get to those final numbers that they want to see. What we've shared with you today is what a lender will typically look for in terms of structure when they want to be seeing what's happening with your setup. So what you could do is take that and just stretch it out to 36 months. The formulas are just something that you can literally take month 18 and just copy them over. They'll extend to the end, and then basically start to lay out what your plan is. And I would say focus on the first 12 months because that's what you know of the most. And then for the next year 2 and year 3, use rather like blanket assumptions and saying, hey, we think we're going to be doing 10% more, you know, extending into this additional market, or we'll need to bring on an additional person on payroll. So focus on just the first 12 months so that you don't feel 36 months is a lot and we have no idea what's going to happen. So, you know, just starting with year 1 and then telling the lender, et cetera, that you're speaking with, giving them reasonable assumptions for what you expect to expand to for year 2, year 3 should be sufficient. That being said, most traditional, I don't know who you're speaking with. So if it obviously, they might have other prerequisites to think about. For instance, many of them ask for, you know, something like 2 years of tax returns and so on. So if it's not one of those, even just, you know, having your projections and your plan laid out in this manner should be sufficient.
Okay, yeah, the plan is laid out, and we're working on the projections right now to see. And in those projections, we're looking at, I guess, what our basic costs are and coming to a number of like where we realize how much money we actually need to make this fully happen. So just trying to understand it all is a task in itself. So I appreciate your help, though.
You're very welcome. And I think the thing to also keep in mind is your plan is what you want to be showing them as well. So don't think of it as, you know, many times it so happens is that you're building your own plan for your business and then you say, okay, I need to put something together for the bankers. Think of it as a unified piece of work that you're putting together. Whatever you're thinking about, you want to just present it in that structure that immediately makes sense to them. That's, you know, so that it's one thing and you're not maintaining 2 parallel streams of thought.
Okay. Well, thank you. I'll probably be here next week too. I'm not sure if I have the time quite yet, but maybe I'll see you next week.
Okay.
Thanks, Mark.
Thanks, Mark. AC, do you want to ask your question?
Okay. So for somebody with an existing business, I know this is like a forecast tool, but would it be useful to look at the year previous and try to fill it in based on all of your previous year's numbers and then use that as a function? Okay.
Absolutely. If you have it, and that's why when we were talking through the how of it, I'd mentioned taking a look at 12 to 36 months of data in the past. That's where you do want to start in the past, unless you're doing a complete change in business model and nothing in the past applies. But no, absolutely. Fill in the past and then start to modify it. And it's a great way to get started.
Awesome. And can I ask one more quick question? When you had the scenario 1 and scenario 2 of like farm and production, I was wondering why someone would separate the 2.
You don't need to. My thought is mainly this: if you're running more than one business model within your business, so you have the farming, but you're also doing production, it's a cleaner thought process, and you probably have seen that yourself. You're like, hey, this is what's going on the farming side. Let me just fill out those numbers. And then this is what's going on the production side when you fill out those numbers. And you may even have a third sheet that says, this is overhead. It applies to everything. And, you know, that's my third piece. And then what you could do is that box that we have at the bottom, the cash flow piece, that instead of, you know, it's going to obviously reflect everything that you're putting in each of the 3 sheets that we've just talked about. But what you could do is just have a fourth that sums it up from all of them so that you can see your unified cash flow at the end of the day. So basically what you'd be doing is literally just summing up this plus this plus this for the parallel boxes on a 4th sheet. So the only reason I suggested or even thought about it that way is if you're thinking of completely different operations within your business, sometimes it's just cleaner to think about them as separate enterprises.
I think it goes to say for all of how you do financials, and this was true for our last workshop on record keeping, it depends, you know, these processes take time to develop in ways that they actually work for you as a business owner. And, you know, you just got to try different avenues until you find what works and what makes sense. Well, I would love to give everybody lots more time, but I want to respect everyone's time. And we are now 8 minutes over. So thank you everybody for coming. Thank you, Anjali. It was wonderful. And we'll definitely be distributing the recording to everybody who is in attendance. So